Get Rich Education is brought to you by Norada Real Estate and Highlands Residential Mortgage.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, you are inside Get Rich Education, episode 139. Hi, I'm your host, Keith Weinhold. The housing inventory crunch inside and outside the United States is on. How bad is it with scarce inventory? How hard is it to find property, whether that's income property or your primary residence? How bad is it going to get, and how does that all affect you? We're going to get into that today, and then later in the show, we're going to talk about your time versus your money. It's a new perspective on trading your time for dollars, which is what most everyone does in their life, whether they like to or not. They usually don't. First of all, thank you for making my book that just released this week, 7 Money Myths That Are Killing Your Wealth Potential, an Amazon #1 bestseller in multiple categories. That's amazing to me. Now, one way to tackle America's shortage of housing is new construction, and we discussed that a bit last week. Bloomberg was recently reporting on how there's one type of rental dwelling that virtually no one is building anymore, and that is small apartment buildings between 2 units and 9 units. And yeah, that includes less of the asset type that I'll always have a soft spot for in my heart, which is the fourplex building, which is where I started out as an owner and an occupant and a landlord all in one. Urbanists often lament that developers no longer erect the small apartment buildings that were really once a staple of city neighborhoods. Instead, what builders are doing is they're either constructing single-family homes or large apartment buildings, but not much of anything in the middle. And there are some good reasons to revive this sort of missing middle, because small apartment buildings, they're a good way to add density without compromising the character of quiet, single-family neighborhoods. And they also provide a convenient way for older homeowners to downsize without having to leave their neighborhoods. But really, the best reason is that smaller apartment buildings are just often cheaper for renters, for one thing. There's new research from the University of Southern California that shows that apartment buildings with between 2 units and 9 units offer the lowest prices available to U.S. renters. Now, some media sources, they try to sort of sensationalize and say, well, the triplex is dead or the fourplex is dying. Well, that's a little bit too strong, but I think we can agree that America is not building as much of this kind of housing as it used to. Small and medium-sized apartment complexes accounted for a quarter of existing units built back in the 1970s and 80s. A quarter then, but now since 1990, the category has accounted for just 15% of new housing stock. So what's going on here? Why is this happening? Well, for one thing, zoning rules have developed to favor single-family construction, and that makes it harder to win approval for these larger projects. There are regulatory costs to build multifamily housing, and developers have to go through a lot of those same hurdles and a lot of that same trouble to win those approvals, whether they build a whole bunch of apartments or just a few small ones. And in general, there are economies of scale in constructing larger complexes. If 2 units are vacant in your 8-unit building, well, then you're missing out on a quarter of your income potential. In a 100 apartment high rise, a couple vacancies are less of a big thing. And those operating efficiencies also make lenders look more favorably on larger apartments too. So it's kind of a vicious cycle for ever bigger residential developments and not so much for smaller ones. Seeing why builders have abandoned the small apartment complex is easier than trying to figure out how to rekindle interest in the concept of building more of these. Rewriting zoning codes to favor that missing middle would be a really great place to start. And then the flip side is that if builders don't develop more small and medium-sized buildings, well, then an important source of unsubsidized affordable housing might dry up. Rental units tend to get cheaper as they age, and the trend in recent decades towards single-family homes and high-rise apartment buildings means that there are fewer, smaller apartment buildings to age into affordability. You need to build housing stock that's affordable today, and you also need to future-proof yourself by building stuff today that's going to be affordable 10 or 20 years from now. So duplexes, triplexes, fourplexes, up to about 10 plexes or so, or even a little bit bigger, they're being brought online much more slowly than they were in earlier decades due to zoning and economic reasons mostly. And that's kind of unfortunate for you because like in the 2 to 4 unit category, those duplexes, triplexes, and fourplexes, that's a great way to start off for an owner-occupant like I did with an FHA loan. And see, those properties, that can also be a good way for you to use accumulated equity from your single-family turnkey properties to move up to from you doing 1031 exchanges and so on. And by the way, coming up on Get Rich Education, we're going to devote a whole show to the details of how and why you can pull off a 1031 tax-deferred exchange to potentially double or triple your cash flow from where it is now and use little or none of your own money to do it. Whenever I've done 1031s, it's always amplified my cash flow and really made like a lifestyle change for me. But for today, getting back to the tight housing inventory problem that we're in, where demand is exceeding supply in many markets, is that the biggest challenge to today's housing market is just that shortage of housing inventory for sale. That's probably the number one problem out there. And the number one answer to solving that problem is new construction. A normal market would see a 6-month supply of homes for sale, but currently that number is below 4 months. This is the major reason that home prices have continued to appreciate at about historic levels or higher than historic levels. And the good news is that now builders are starting to build more homes in the lower price ranges, which is where they're really needed. But the bad news is that there's going to be a lag time, so there's going to continue to be pain felt here. So let's look at the housing shortage problem from the perspective of the homeowner, the primary residence owner for a moment, rather than the landlord, which is what we usually talk about. Now, we've got mortgage interest rates that are still astoundingly low, about 4% for an owner-occupied 30-year. And for your income properties, you're still getting less than a 5% interest rate, even though, people have been expecting interest rates to rise substantially for, 5, 6, 8 years here, and rates still haven't risen much, but there does project to be more of a likelihood of a substantial move up in mortgage interest rates with these Fed funds rate hikes that we've been having. Now, if mortgage interest rates do go up, coupled alongside with this inventory problem, then homeowners could start to feel imprisoned in their own home. Business Insider was reporting how they say the housing recovery is sort of a mixed bag, okay? With slow wage growth, that means that there are fewer affordable houses available to buyers, especially in the bigger cities. Now, on the surface, the price trend looks kind of good for existing homeowners to sell because you figure that with basically a full housing recovery that's taken place over the last 8 years, that homeowners could sell and they wouldn't take a loss. They might even have a nice gain to show now. You think they might even want to sell. But the likely rise in mortgage rates from historic lows, that means that there would be less incentive to move, and you can feel like a prisoner inside your own home because of rates. There gets to be a growing challenge of an increasing financial penalty caused by the interest rate lock-in effect over time. Now, since the 1980s, basically interest rates have just gone down, down, down. And that created sort of a built-in incentive to move because when you would move into a new place, you would get a lower mortgage interest rate along with that, and that helped affordability. Now, even if a seller's income was unchanged, it was possibly effective to move into that lower mortgage rate, even if that home price were higher, and so be able to even afford a slightly bigger home. Now, the likelihood that rates will rise from historic lows, that spurred this so-called rate lock-in effect. Some homeowners, they might not sell because of the perceived or the actual difference in their monthly mortgage payments if they swap out their old rate for a new, higher interest rate. And the prisoner's dilemma is that in a market with tight inventory, the decision to sell depends on whether that homeowner wants to risk selling and then not being able to find a new home. So the existing homeowner is trapped in this prisoner's dilemma of sort of the cooperative outcome. Okay, if everyone acted simultaneously, it would sort of solve the problem as everyone moves around, but we can't take the risk of being the one that acts when someone else might not. In some cases, like when a homeowner is moving across the nation, then, sure, the sell decision is quite a bit easier to make. It's almost obligatory. And there's also a level of home price appreciation that still does sort of make selling an attractive prospect. So then the question becomes whether new homes can be built quickly enough to catch up to housing stock demand. So this gap, this lag time, has created the most competitive buyer's market on record for existing homes, just judging by how long homes stay listed. That's according to the National Association of Realtors. And, by the way, you want to consider the source whenever the NAR, the National Association of Realtors, is quoted. The NAR, they want to promote home ownership and home sales and almost all the sunny side up stuff on home buying, okay? So you always want to take that with a grain of salt. But according to the NAR, in April, existing homes listed for a record low median of 29 days. Shorter listing times, they suggest that buyers are snapping up houses as quickly as possible, indicating a hot market. In reality, these conditions, tight inventory and high demand and rising prices, they really look to be with us for quite a while to come here. So think about how this might make you feel in present. You don't want to risk moving if you're already a homeowner, partly due to the fear of having to pay a higher rate by the time that you close on your new home. Well, that can make you less likely to want to sell in the first place, which then means there is even less inventory available when people don't want to sell, so this problem kind of feeds upon itself. Lawrence Yoon, the chief economist of the NAR, he recently said that sellers are in the driver's seat as the intense competition for the few homes for sale is forcing many buyers to be aggressive in their offers. Buyers are showing resiliency given the challenging conditions, but at some point, and the sooner the better, price growth must ease to a healthier rate. Otherwise, sales could slow if affordability conditions worsen. All right, that's what he said. Let's look at what some of the other industry experts have to say on this tight inventory subject. Ralph McLaughlin, the chief economist at Trulia, he was quoted as saying, nationally, housing inventory dropped to its lowest level on record in 2017 Q1, which was the latest quarter ended. The number of homes on the market dropped for the 8th consecutive quarter, falling 5.1% over the past year. That is substantial. Tom O'Grady, the CEO at Protect, said the lack of inventory is very real and could have a severe impact on home sales in the months to come. Traditionally, a balanced market would have an MRI, that's months remaining inventory, between 6 and 10 months. Okay, so that's a balanced market. But this month, only 8 metros that they track have months remaining inventories over 10. Last year, there were 27, and 2 years ago, there were 48 of those. So that's how bad the lack of inventory is. And it's not being driven only by traditionally hot markets, but this is a broad-based national phenomenon we have here. But some of the good news is that builder confidence is up, and we need those builders to jump in and give us that new inventory to pull us out of this paltry housing availability problem. So the housing market index from the National Association of Home Builders, not the NAR, but the NAHB, that reveals that builder confidence did increase here in the recent months. NAHB chief economist Robert Dietz, he said that the housing market index of future sales conditions reached its highest level since June of 2005. So that's showing a lot of builder confidence as they're really trying to add more new construction units. So that's that. And let's be mindful that new construction is not all the same either, okay? Some good news is that builders are meeting the needs of today's purchaser. So builders are not only jumping into the market, they're doing a better job of matching current demand. The Wall Street Journal was recently writing about how home builders are shifting their focus away from luxury homes and toward homes at lower price points. And this is key because of slow wage growth. So on the single-family home front, you're seeing an increase on homes built under $400,000 in sale price and a decrease in new construction nationally of homes of more than $400,000. So back to income property and its supply for you. A lot of national turnkey income property providers are having problems with inventory for you, the investor. One thing I do is I travel inside and outside the U.S. to find not just the markets where the numbers make sense for you and you can get some rental cash flow, but keeping current with those providers that actually have some turnkey income property inventory for you. And the good news is that one of those places is Jacksonville, Florida. It's one of the few U.S. coastal markets where the numbers can actually make sense for you. And, years ago, our smart Jacksonville providers saw the inventory crunch coming, and they jumped ahead of it. And as of last week, they had at least 10 turnkey income properties available for you right now. You can find out more, and you can get a free report that they put together for you about the Jacksonville market, and it has all their contact information. You can get that report at getricheducation.com/Jacksonville. Or if it's easier, just go to getricheducation.com/JAX. Either one will take you to the same place. Let's talk about why you think you need to own the home that you live in as opposed to renting your primary residence. And then let's talk about your time versus your money. I'll be back with that in less than 100 seconds. You're listening to Get Rich Education.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
Are you looking to invest in your first investment property or grow your existing inventory? Highlands Residential Mortgage can help, offering down payments as low as 15% and credit score requirements down to 620. Their streamlined process is designed to help investors close their loans quickly and without any surprises. You need someone who knows cash flowing real estate and can help guide you through the muddy waters of today's lending environment. So call Graham Parham today, toll free at 855-326-6802. The Parham team can help you purchase or refinance any of your 1 to 4 family investment properties.
NMLS number 195724, 12001 North Central Expressway, Suite 750, Dallas, Texas 75243. Equal housing lender, not licensed in all states.
This is Rich Dad, Poor Dad, author of Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. Hey, I know we've had a lot of listeners ask me about when Tom Wheelwright's tax-free formula is going to open back up again, these great video modules for taxes. And the answer is very soon, later this month. You know, think about it. If you've got Tom Wheelwright's team on your side, the same tax advisor that I use, and you're paying out, say, $10,000 less per year in taxes after using him, those are dollars that you can leverage 5 to 1 and buy $50,000 more of cash flowing real estate next year. And Tom has a type of expertise that can give you the ability to do that. And he presents something boring like taxes in a refreshing, approachable, and enthusiastic way. And our free newsletter subscribers will learn about when that program opens up here again soon. I've got a question for you. Do you think that you need to own a home? Do you think that you need to physically own the home that you live in? Well, if so, why do you think that you need to own the home that you live in? It usually makes the most sense to be a renter in a nice home that you live in, and then the only properties that you own are low-cost homes in the Midwest and South that you rent to others. That's what makes the most sense strictly from a financial efficiency standpoint. We know that the home ownership rate is at multi-generational lows here, but yet I still run into people all the time that think that they're almost like some sort of failure if they don't own their own home. Most recently, in fact, the guy that mows my lawn, Gary, he's a nice enough guy, a few years younger than I. He and his wife are renters in a condo, and they told me that they really want to own a home. Like, that's a real priority of theirs. And I kind of found a roundabout way to get to them and say, well, you know, for probably at least half the places in the U.S., including here in Anchorage, it typically makes more sense to rent rather than own. And then the next thing that they told me is they want to sail a boat around the world for a year or two. I mean, geez, then that really gets to tilting more toward renting. But anyway, paying rent is not like throwing money away. When you pay rent somewhere, you have the benefit of living there. You get something in exchange for that. Okay, if you pay $20 to ride a roller coaster, you don't own equity in the roller coaster track or a fractional share of the roller coaster car, and you didn't expect to. When you rent a boat for the day, you have the benefit of using the boat, fishing from the boat for the day, and you don't own shares in that boat, but you got the benefit of using it. And additionally, that stuff, roller coasters and boats, that's discretionary spending, and yet you're willing to do that. So you ought to be more than willing to rent a home when that's not discretionary. A place to live is mandatory. So in this era of tight housing inventory, should you even be looking for a place to own and call your own, or should you be a renter? Well, I can't tell you definitively yes or no for your situation, that's for sure, but let's look at some of the trade-offs between renting versus buying the home that you live in. And there are 16 trade-offs that I came up with here, some of which you've probably never thought about and others that you likely have. The first one of the 16 probably takes the most time to explain, and that first one is the dynamic between the property price and the rent-to-value ratio of that property. If a home costs less than $250,000, own it. If it costs more than that, then pay rent, because on higher-priced homes, you get more home for a smaller rent amount that you're able to pay. If you can pay just, say, $2,500 in monthly rent on a $500,000 home, well, then you get the benefit of living inside a home where you're only paying a rent-to-value ratio of 0.5%, 2,500 divided by 500K. You can buy property in the Midwest and South for $100K and rent it out to someone else and get not $500, but you can get $1,000. So now you're exploiting a 1% rent-to-value ratio to your benefit. That property probably cash flows. Someone, a tenant, is either uninitiated or financially disadvantaged, and they have to pay you a high rent proportionally to the low price that you locked up that turnkey property for. So if the monthly rent is under $700 per $100,000 of home, be a renter in that yourself. If rent costs more than $700, own it. This is a formulaic approach, and that indicates how much home you have the benefit of living in per dollar paid. And now there are definitely regional and other factors that can skew these numbers for sure, but I'm just kind of giving my best there for a national average or estimate. So that's the first of 16. The second trade-off between renting versus owning your primary residence is that of mobility. You're likely going to move more often than you think. People move more than they think, not less. Renting keeps you nimble. With a new job opportunity or a life change like marriage and kids, your mobility is an asset. A homeowner that moves a lot, they get so eaten up and beaten up with closing costs and make-ready expenses and sales commissions. When you sell a property, you can pay 8 to 10% of the sale price in sales commissions and make-ready expenses alone. The third trade-off is choice. When you're looking for a place to live, there are certainly more homes for sale than there are rentals, especially at the higher end. Well, that tilts towards being an owner rather than being a renter. The next trade-off is equity buildup. Equity is the difference between what your home is worth and how much you owe on a mortgage. Homeowners build equity, renters don't. Equity is like a forced savings plan, but equity is an awful investment with zero return because the presence or absence of equity has absolutely nothing to do with whether or not your home appreciates. Yet you would still rather have equity than not have it, everything else considered equal. But homes make terrible banks. Homes are meant to house families, not store cash. Next, consider liquidity. Although most homeowners build equity, it's difficult to access those funds. To tap your home equity, you must prove to a bank that you qualify again and wait months and incur costs, and you might still be denied access to the equity. So if you can rent that property for less each month, you have liquid dollars that you're able to accumulate. The next trade-off is opportunity costs. Most people tie up a 20% down payment or more in home equity. And like we just said, equity dollars are low use, zero return dollars. Instead, your chunk of money can be earning a return for you somewhere else. Next, consider what I call sunk cost. Sunk cost, that's an overlooked killer for homeowners. You've got mortgage loan closing costs and constant home maintenance and repair, property tax, utilities, landscaping, snow removal, replacing obsolete fixtures once in a while, appliances, roofing, painting costs are never fully recouped, and renters bear fewer of these sunk costs. Next, consider control. With control, homeowners have the advantage here. The peace of mind of knowing that a landlord cannot tell you to move is priceless. You have a feeling of belonging. You have an anchor. And as a homeowner, you can knock out a wall or renovate your kitchen or add a fence between you and a neighbor. You can make it yours. The next trade-off is appreciation. Renters don't experience price appreciation. And even worse, renters might have to weather rent price increases Homeowners with loans, they benefit from financial leverage. Leverage can amplify your wealth in an appreciating environment, although you're going to be really lucky if leverage appreciation offsets ongoing opportunity cost and sunk cost, and inflation becomes your friend when you have a mortgage, if you think we're going to have more inflation. Next are tax advantages. Homeowners often get the mortgage interest deduction, but this is really just a smaller consideration than how most people think of it. Even Rich Dad advisor Tom Wheelwright himself says, don't let the tax tail wag the dog. The next thing you need to consider are low mortgage rates. Homeowners can tie up long-term fixed interest rate debt here, still at these historically low rates. Consider the community formation trade-off. Owning your home, it provides both you and your neighbors sort of this feeling of belonging. Homeowners are more likely to look out for the common good of the neighborhood, and that helps everyone in the neighborhood, and people just kind of feel more fulfilled when they're part of something greater than themselves. It's that sense of community. What about travel? Travel is so simple, yet everyone kind of overlooks this. Have you even been to New York City or Arizona or Alaska or Florida or Peru? You know, it amazes me when I learn how little some people have traveled. If you haven't ever gotten out to see the very world that you live in, be a renter until you've found the place that fits your interests. Now, if you have a lot of family that lives where you live, well, that tilts in the direction of you wanting to be an owner. The next trade-off is personal cash flow. If it costs substantially more to own a place rather than rent that place, then by all means rent it and vice versa. Homeowners that divert too much of their income into a mortgage payment, they're what's known as house poor. And being house poor, that stifles your opportunity to travel and invest and provide opportunity for your family. Think about natural disasters. Areas subject to frequent earthquakes, hurricanes, and floods, that clearly tilts to the renter's advantage. Even if you're adequately insured, those catastrophes are worse for homeowners. And then finally are consumer advantages. I'll kind of call that consumer advantages. That's where owning rather than renting, that can give you higher credit card limits and more favorable insurance rates. And that's all 16 of the trade-offs that I came up with you to consider there. You know, a decided stigma still exists with renting. There's just no doubt about that one, but you don't live your life for the Joneses, you live it for you. Regionally, it makes more sense to rent on the U.S. coasts and own in the heartland, but there are surely numerous exceptions to that. So what's the bottom line to you? What makes the most sense financially? It is to be a renter in a high-end home yourself, and then buy a whole bunch of low-cost income properties that you rent out to others. But there's just no one definitive factor in the rent versus buy decision, because this is where your finances and your feelings intersect. As soon as we're talking about where you live, feelings come into the picture. When it comes to income property, it's all about the facts. So here's hoping that you found just a few considerations there before that you've never thought about. Moving away from that, let's talk about time versus money, something of critical importance here. And this is a contribution from my friend Jerry Fetta at AG Capital, agcapitalgroup.com. So let's be hypothetical. Let's say there are good and bad consequences in your life, and let's say that there is some method in your life that if you followed it, it could create an outcome where only good consequences would exist for you. Well, how would you get there? All right, well, the first thing you would need is a clear, concise mental picture of what it is that you want to have. What is the consequence you would like to obtain? And I think pretty unanimously, we can agree that we all want to have a life by design, right? So let's go with that. You want a life by design. Now, if you're trying to obtain that, what are the things that you need to exchange with your life such that you can have enough control to design life itself for yourself? So really, life by design means freedom of time, and what you choose to do with that time is what you choose to design your life with. So life by design means that you need freedom of time. So what do you need to exchange with your life in return for freedom of time? Do you need to exchange food for that time? No. Do you need to exchange love for that time? Nope, it's not that either. Do you need to exchange worship? No. Do you need to exchange service? No. Do you need to exchange fresh strawberries for time? No. Do you need to exchange time to get time? Maybe. No, it's not that either. It's money. You need to exchange money to get time. Yeah, the answer is money. Money is the only thing that can be exchanged for time, practically speaking. You see, we live on an economic planet, whether we like that fact or not. Money will not buy you new time, but money can prevent you from having to spend the time you currently don't have on things that are not a priority in your life. So if money must be exchanged for time, well, then one question is how much? Well, how much time do you want? You probably want as much time as possible. The logical answer is we must exchange as much money as possible to get as much freedom of time as possible. So let's add a short lesson in economics into this, okay? In 1913, $1 was equivalent to $24 today. So that means that money has gone down over 2,400% in the last 100 years or so, okay? That means our money is going down in value by more than 3% every single year. Okay, that's the story with money. Now, what about time? You don't know how much time you will continue to have, and you cannot get back the time that you've already spent either. So doesn't this mean then that time continues to go up exponentially in value by the second? Yeah, I think you can say it does. Well, then realize this. You can trade money, something that we just said goes down in value exponentially, in exchange for time, something that goes up in value exponentially, and there is no limit to how much of this exchange that you can make. You've got to wonder where you can sign up for a deal just like that, and that right there is exactly what makes the creation of passive income, money that you don't have to trade time for, an exponential multiplier to your freedom of time and your quality of life. So consider the import of making the creation of time in your life through building passive cash flow streams with income property. That's why we talk about this here on the show every week, and that is so vital to your chosen lifestyle design. Again, thanks for making my book, 7 Money Myths That Are Killing Your Wealth Potential, an Amazon #1 bestseller in multiple categories, where it just debuted here last week and has content similar to that time versus money stuff that we were just talking about. You can read my new book in under 2 hours, and you can get yours at getricheducation.com/book. For my developers, John Collins and Marcus Whelan, sound engineer Vidran Jampo, web designer Nikon Roy, I'm your host Keith Weinhold. We'll see you next week. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by Your Home for Wealth Building. GetRichEducation.com.